Good afternoon. Welcome, everybody. It's 23rd of February, 1 o'clock. Welcome to our webinar. Those of you logged in late, so this webinar is being recorded, so I hope I'll be able to send it out by tomorrow, as well as a PDF of the presentation. So as you can see by the title there, are you a share investor or trader? The reason I'm asking that question is I find that a lot of people, they go and open up a share trading account with us because they want to make money. But I also find that people don't understand that investing and trading are two different methods of attempting to profit in the share market. So, you know, this is obviously applies more specifically to a novice or to a beginner. They open a share trading account, but with no clear idea of how to go forward. So, you know, I'm referring back now to a book I read many years ago called It Starts With Why. It's Simon Sinek's book. And imagine three circles. Right in the middle is the question why, and then the second circle out from there is the what, and then the how. So I think that a lot of people open a share trading account without not understanding the reasons why they're opening it. As I say, yes, they want to make money, but it's how you're going to do it. So also what's important is what are you going to be trading? What is your investment strategy? What is your trading strategy? Hence this presentation today. I think a lot of people are going blind, and then they're getting confused, and then they give up, put it that way. So the big difference between the two from the outset is your time horizon, and you'll see in a few slides just now how we differentiate between the two. But also the term investment strategy refers to a set of principles that's designed to help you as an individual achieve your financial investment goals. It's the same with trading, you know. So with investing, we talk about the two common ways of looking at investing. Is you're going to be a value investor, or you're going to be a growth investor, or you can be both. As a trader, on the other hand, obviously there's also the thinking behind it is having an established method in the sense of planning and making trades, and we'll go into more detail of that also. But the bottom line, as I say, is having those reasons why you want to have a share trading account. Okay, so here's my call it agenda. We're going to answer that question: what is your strategy, or your investor or trader? And that's my goal today. At the end of this presentation, hopefully you got more clarity. You understand your investment strategy or your trading strategy, or you might be both. Okay, we'll go into more detail about that. But let me start another question here. You know, what is the main reason that most people fail to invest successfully? Now, is it a lack of information? Is it too much information? Is it a lack of time to devote to investing? Is it a lack of investing knowledge? Or is it a lack of tools or software or programs? Or is it just plain old bad luck? You know, and I think in most cases, the main cause of poor investment returns or trading returns is a person looking back at you in the mirror. In other words, it's you. Okay. So it's our behavioral tendencies that we as humans use when making investment decisions or trading decisions. So the main thing here is we get emotional. And I think that is the biggest enemy in the share market. We get emotional, we have greed and fear. And hence the reason why I'm saying you need to have a investment strategy or a trading strategy. Have it documented so it helps you to become more objective. Okay, I hope that at the outset will give you a bit some more information. So what is your strategy, or investor or trader? As I say, what's important to understand here is the what. Okay, before we get into the how. Okay, so you know, the goal of investing is obviously to build wealth over the long term. So in other words, we're having a buy and hold strategy. But it's long term. Trading involves more frequent transactions. In other words, buying and selling, and your goal is to outperform a buy and hold investment strategy. So you know, the main thing here is that an investor would enhance their returns by reinvesting dividends, for example, whereas a trader will try and, as I say, try to outperform a buy and hold strategy by, you know, doing it more frequent, trying to make profits more frequently and reinvesting that. But the thing also with a long-term investor, you know, we, as I say, long-term, so we ride out the market downtrends, and with the expectation that prices will rebound, or any losses will eventually be recovered. So that's the main thinking there. We're more concerned about the market fundamentals such as price earnings ratios and management forecasts. That is a buy and hold investor. So with a trader, obviously your time frame is much shorter. We're going to take smaller, more frequent profits, but the main idea here is it's shorter term. Okay, so as an investor, let's use the example that you want to go for 10 or 15 or 20% growth per annum on your whole portfolio. Let's use the example of 20% growth on your whole portfolio every year. So theoretically, you should be doubling your portfolio. A trader, on the other hand, will be looking at 10% growth per month. So it's a totally different mindset. Okay, and we'll be touching on it very briefly today. So obviously the focus is more on equity trading, but I'll be bringing in derivatives like single stock futures and CFDs. If you're going to be more actively involved, I would sincerely recommend you looking at opening up a CFD or single stock futures account. It's more capital efficient, and obviously the cost is much lower. Okay, so that just as a as a side. So some of you might have seen this slide before, investor or trader, and this is what I want to highlight, as I said, is that the difference between the two of them. Your time horizon as an investor is 3 years plus. Okay, as a trader, it's less than 3 years. Just the reason why I'm saying that is because of tax reasons. If you're buying a hold of share and you hold it for at least 3 years, then capital gains tax applies. You can see the inclusion rate is 41%, and the maximum tax rate you can pay is 45%. So 41% times 45, the maximum you'll be paying as an investor is 18.45% on your profits. Whereas a trader, obviously any profit you make is considered income, and obviously might push you into a higher tax bracket. The most you'll be paying there is 45%. So those are the things you have to consider when you're looking at that question, are you investor or trader? If you are considering being an investor and a trader, I suggest you have two separate accounts. Have a investment account, what I call capital account, and you have an income account, totally separate. And again, what I just said just now, I suggest rather look at CFDs and single stocks as a trader. Okay, so as an investor, you're looking at passive management. When I say passive management, it's not the same as unit trust. I'm going to have a long-term portfolio, buy and forget. When I say passive management, I might be watching my portfolio once a month as an investor. Okay, as a trader, obviously it takes more time, so it's more actively involved, and especially if you're trading single stocks and CFDs, you're doing it on a daily basis. Okay, my goal as an investor is to build a balanced portfolio. I have some industrial shares, some financial shares, and maybe some resource stocks. Obviously I take advantage of what I call rand hedge shares. If the rand gets stronger, your financial shares benefit. If the rand gets weaker, your exporters or your miners, for example, or your resource stocks will benefit from it. That's what I mean by a balanced portfolio. But as a trader, you want to have a handful of positions. 5, that's the most I've ever found that I feel comfortable with trading single stocks or CFDs. My goal as an investor is to buy into quality, undervalued shares. Obviously, I'm a value investor, but also safe. When I say safe, they're not speculative, they're not risky, there's cash flow, etc. But my main focus as an investor is to build a diversified portfolio. Okay, as a trader, very importantly, I'm focusing on risk management. It's not about making money, it's avoiding capital losses. So we're talking about position sizing and stop loss. Very important as a trader. As an investor, I'm using more fundamental analysis. Also a question, what must I buy? So I'm looking at more of the financial statements. How good will this company be as a generator of future profits, dividends, etc. When it comes to trader, timing is my critical success factor here. When to buy, when to sell. As a trader, I could use different styles, depends how much time I've got. And most of you will be what we call position traders, holding from a few weeks to a few months. Some of you might be shorter term, swing trading, holding from a few days to maybe 2 weeks, for example. And a very small percentage of you might be what you call day traders. Those are more the index futures traders, the guys with big money, making small percentage movements, gains, but doing it more often intraday. As an investor, my buy and hold strategy, I can either be a value investor, a growth investor, or investing for dividends, or a mixture of all three of them into one portfolio. But my goal is capital growth and in income from our dividends, as well as growth in those dividends every year. Okay. As a trader, my goal is also to make capital growth, buy low, sell high. That's with normal shares. And I can also take advantage of falling markets, especially with derivatives or single stocks and CFDs. I can sell high and buy back lower and take advantage, as I say, of falling markets. But I'm still taking advantage of capital growth. If I'm buying and holding one, if I buy a share and I hold it for long term, my costs are much lower. And obviously, as a trader, I'm buying and selling, my costs are much higher. Beware of those kind of things. Okay, so I hope that gives you a bit more insight into that. As a quick introduction. So what is your investment strategy? It comes back to what I said just now. Are you an investor or a buy and hold investor? What is your investment strategy? How are you going to make the money? What kind of stocks are you going to look like building into your portfolio? So the idea here is having something written down so that you can follow. So yeah, just 5 common mistakes that I find a lot of novice investors make is that they have information overload. They're following too many things. They watching the news, watching Googling and things like that, and they have information overload. They like a deer in the headlights. They don't make a decision, they don't make money. So beware of that. What I suggest you guys do, and is very important, even for the traders, is maybe consider joining our WhatsApp or Telegram group. This is information sent directly from our dealing desk. Information that buying opportunities, selling opportunities, but also research. So it just narrows your universe. You don't get that information overload, especially those of you that are as I say, a novice. If you're first starting out, your first investment, I always say, is in your education. And I'm still old school. I believe in reading books. There's a lot of books you can go out there and read. But more specifically, if you're looking at becoming a value investor, go to the horse's mouth. Go read a book called The Intelligent Investor by Benjamin Graham. It's not easy reading. Benjamin Graham was Warren Buffett's mentor. If you know who's Warren Buffett, #1 investor in the world, he's #1 value investor in the world. But go read that Intelligent Investor, gives you more insight into value investing. And those of you that want to become more involved with growth investing, is one book I recommend, is called One Up on Wall Street by Peter Lynch. You'd also go so far as to read a book called Common Stocks and Uncommon Profits by Philip Fisher. He's also more into the growth stocks and things like that. So the biggest challenge I find with a lot of the novice investors, they don't understand the risks involved. Yes, they want to make money, but the higher the potential returns, and the stock market has provided higher returns compared to putting money in the banks, but you also understand higher potential returns comes with higher risk. So you got this risk that the whole market might drop, okay? And you have to say to yourself, where's the market right now? What is the PE ratio of the whole market? How does the sector compare? How does the share compare to the sector, etc.? So a lot of people buy shares at the top of the market, getting the timing wrong. They might be buying a good company, but the wrong timing, or buying the right company at the wrong time. Okay, excuse me. So be aware of those risks. The whole market having a bit of a pullback. Alternatively, also buying into a share that's what do you call specific risk. Again, you want to have your whole portfolio consisting of gold shares. You don't have your whole sector consisting of retailers. So that's again why I'm suggested that you have a diversified portfolio. Another thing I always see with novice investors, they start with limited capital. Yes, while at PSG we don't have a minimum amount to start with, just be aware of our costs. Now, minimum brokerage on the direct sale side is 98 Rand per trade. So if you had a start of 1,000 Rand, just understand that your stocks has to move up 9.8% to break even on costs. Okay, just on brokerage alone. So if you're getting your timing wrong and buying at the top of the cycle, imagine as the price is falling down, it's going to take you longer to break even. I suggest, and this is again not for everybody. Start with 100,000 Rand. You can go buy 10 different companies, 10,000 Rand each. 10,000 Rand per trade is about 1%. So you can easily move up 1% in the morning, you're breaking even on costs. But also, more importantly, you're building a diversified portfolio, and that's where you're managing risk. Okay. So talking about diversified, you don't want to be too over diversified. I've seen some portfolios look like a unit trust account. 50 shares in the portfolio. It gets to the stage where you're so far over diversified that it doesn't really apply anymore. And then what I said just now, getting your timing wrong, buying at the top of the market, and obviously you have to wait for the market to recover. So be aware of those things. We'll be touching on more of it later. Okay, so the two real approaches for most people is what we call value investing or growth investing. Growth investing involves investing in companies that's going to mainly outperform the market. So you're looking for companies that have high potential for growth. So they're priced higher than the market. When I say priced, it's from a valuation point of view, from a PE ratio. Now the average of the market, let's say, for example, 12. These companies will be trading on a PE ratio of 20. Now, those of you who are novices, the best way to explain that, you want to have a low PE ratio. So the higher the PE, it means it's going to take you longer to recover the money out of the market. So a PE of 20 is going to take you 20 years to recover the current earnings out of the market, as opposed to a company that's got a 12 PE. It's going to take you 12 years. You want a low PE. The inverse of that is what they call an earnings yield. So it's like a savings account. You want a high earnings yield. So it's the inverse of the PE ratio. I'd rather have 10% growth on my money than 5% growth. Okay, so you find that growth companies have a high earnings growth record. You'll see they grow their earnings every year by inflation plus 10%, for example, 15% plus growth per annum. If they're growing their earnings by at least 15 or 20% growth per annum, what do you think is happening to the share price? The company should be growing by at least 20% also growth per annum, by 20% growth per annum. But they're also more volatile. Okay. So be aware of those kind of things, especially with growth stocks. Value investing, yeah, we're basically we're looking for shares that are trading less than its intrinsic value. So here's another term I could bring into you, what they call net asset value. If I take the company's assets minus all its liabilities, what's left behind or left over is what we call intrinsic value. Okay. So you'll have two different people having two different views on intrinsic value. What's important to understand is that there's various ways to look at that. You compare the share price to the intrinsic value or NAV. It helps you to determine if the share is cheap or expensive. Ideally, you want to buy into companies that are trading below, as I say, intrinsic value, what we call trading at a discount. Okay. So that's the kind of companies you're looking for. We're going into more detail just now. Whoops, sorry. Go back to this. So what is value investing? As I say, you're basically a bargain hunter. You're looking for shares trading less than they're actually worth. So you're looking for a share that's trading at 10 Rand, but they're worth 10 Rand, but they're trading at 5 Rand, for example. Okay, so that's where that difference comes in. So we mainly believe that as value investors, we believe that we're looking for companies that are the market as such is undervalued. In other words, the market has sold it off or they're ignoring it. But we also find that the market overreacts to bad news and good news, especially right now when the company releases their earnings results. You find that the market either jumps up or the market jumps down or nothing happens because the market has discounted those events into the share price already. So if the results come out and it's better than expected, you find that usually the share price will jump up. If the results come out worse than expected, you find that the share price will get hammered. And if the market the results come out as expected, you find that nothing really happens to the share price because it's been discounted into the share price already. Okay. So our main objective as a value investor, we want to take advantage of shares that are trading below what they're actually worth, and until such time where the market cottons onto the actual real value of the share and responds to what we call the company's fundamentals. So this company is actually worth more, and obviously demand to push the share price up higher. Okay, so that is the whole idea with value investing. I'm a bargain hunter. So the main idea also and this is the concept from that book, Benjamin Graham's book, Intelligent Investor, buying to shares that have a margin of safety. So you're buying to a big enough discount. If I get it wrong, it's not going to go much lower. That's the idea here. Okay, so it doesn't matter what methodology you're using. Bottom line, I want to buy into a company that's trading less than it's actually worth. Just going back to my example, if the share is worth 10 Rand, I want to buy it for 5 Rand. Okay, that's the goal with a value investor. As a growth investor, a bit slightly different. As I say, yeah, I'm looking for companies with high growth potential. So you're looking for companies that's growing its earnings by at least 15% growth per annum. You'll find that it's usually companies with higher PE ratios, with PE of 20 times plus, and you'll find that price NAV is at 4 times. People are willing to pay a higher price for these growth stocks. So what I have in my portfolio, I have some value stocks, I have some growth stocks to balance it out as such. Yeah. But growth investing and value investing, they're diametrically opposed. I like to have them in one portfolio just to achieve that minimum growth of 20% growth per annum. Okay, so that is what we call growth investing. Okay, go one step further. There's a thing called GOP, growth at a reasonable price. That is, and that's Peter Lynch. He came up with this whole idea. It's basically taking ideas or principles from both value and growth investing. So, with GOP, with growth investing, we're looking for companies with a high PE ratio. Yeah, we're looking for maybe a lower PE ratio, maybe 15. As I say, the market it might be trading on a 12 PE. I'm willing to go between 12 and 15. But I'm still ideally looking for companies that are undervalued based on the price NAV. I haven't really spoken about other things like a PEG ratio, but all those things come into consideration when I'm looking at these companies. So, we're leaning more towards a lower PE multiple compared to a growth PE, the growth investors. But to me, it's very much the same thing. Okay. So that is, in a nutshell, investing. You need to decide for yourself, okay, am I a value investor or a growth investor? And by the way, we haven't really touched on it, is dividends. If I'm a long-term investor, I want to take advantage, as I said, enhance my portfolio with dividends. So I want to ideally go for companies that have a high dividend yield that is sustainable. The average of the market is about 3% growth in dividends, or 3% dividend yield. If I'm finding a company that's undervalued and it's profitable and it's got at least a 5% dividend yield, those are ideal companies, the magic wand. If I had a wave a magic wand, those are kind of companies I like to get into. Okay, so I hope that, guys, makes a bit more sense to you. So those of you that are more lean towards the the trader, there's a lot of things that I can touch on very quickly. As a trader, you'll find that there are certain things you have to take in consideration. As I mentioned just now, your account size, and ideally 100,000 Rand plus will be ideal, because you want to have maybe 5 stocks, 20,000 each of them. As a trader, if you're trading equities, if you're trading derivatives, if I'm putting down 100,000 Rand and I'm putting my initial margin only about 15%, your gearing is 6 times. So that's all things you have to take in consideration. But as a novice and you're considering trading, I sincerely recommend rather get involved as a buy and hold investing. Understand what makes the market go up and down, what causes the share price to move up and down. Basically, yes, it's supply and demand, but also more importantly is sentiment, market sentiment, how people perceive future prospects. So you as an investor, novice investor, will get a better understanding of the market, and then later on open up a separate account for trading. Okay, so there's 4 kinds of investors. I always say, you can look at someone that's very conservative, that looks for low risk, low returns, then rather put your money in the stock market. I mean, in the post office. The stock market is not for you. You want to preserve your capital, rather direct share investment is not for you. Rather get involved in unit trust and put your money into an income fund or a money market account. Go up the ladder towards more higher returns, but at a lower risk. This is what we call a prudent or a moderate trader. So yes, I'm going for higher returns at lower risk. So this is what we call probability trading, and this is what I focus on a lot. That's where the quadrant you want to be in. And then moving over to the right, this is where the aggressive traders I find. These are the guys who want to go for higher returns and are willing to accept higher risk. So that's what we call aggressive traders. And then right at the bottom, in the bottom right-hand quadrant, these are the speculative guys. These are the guys that are going for the high risk, but lower returns, and that to me doesn't make sense to me. So it's someone that's more of a gambler. I won't even call you a speculator. You're a gambler if you want to go for high risk at low returns. Okay. So there's certain things you have to take in consideration. Yes, account size, the amount of time that you dedicate to trading, or touch on just now with the trading plan, your level of trading experience, and there's a lot of other things we can take in consideration. You know, it's a combination of your experience, your skill, your knowledge, but also things like discipline, your self-discipline, sticking to a plan. Also, you can call it forward thinking, that kind of intuition as a trader, try to anticipate future events. So those are all part of, you can call it personality also, you know, your psychology, your personality trait as a trader. You things, as I mentioned just now, having the discipline, the patience, the adaptability or flexibility to situations, but also the mental toughness, and being independent. If you're sticking to a trading plan, not being swayed by other people's opinions, that's what you call independence. Okay, so that's just very quickly about trading. So let's get into more detail here. So the mistakes that novice traders make, again, very similar to the investor, not having a definite plan, investment plan or trading plan, and I'll touch on it again just now. But basically, you find that experienced traders get into a trade with a well-defined plan, a trading plan, and I'll touch on it just now. They know exactly when they're entering a trade and when they're getting out of the trade. Also, the amount of capital they're willing to risk on each trade and the maximum loss they're willing to take with each trade. So that's very important. The biggest problem I see of novice traders, they are trading without a stop loss. It's like climbing into your car and not driving with a seatbelt on. Your stop loss is your seatbelt. Just in case your fundamentals or technicals don't work, your stop loss is there to help you. It's to minimize your losses. Okay, very, very importantly. And I find that people that do not have a stop loss in place will let their losses grow. And that's also a big, big no-no. You never let your profits go. You must make small losses all the time. Okay, so cut your losses quickly. That's what's important here. So one of the defining characteristics of a successful trader is the ability to take small losses quickly if the trade is not working out and they move into the next trade idea. Okay, so they find that the novice traders, they get paralyzed, and yeah, the share price, the price is dropping, and they do not do anything about it. So do not let your profits grow. But also on the other side, let your profits run. You know, cut your losses quickly and let your profits run. Never ever also average down. I find that people that don't have a stop loss and are letting their losses grow will do the fourth thing there, averaging down. Okay, so the averaging down is, I find that people don't have a stop loss in place. Now they're throwing good money off to bad money. So cut your losses quickly. Okay, so what are the two strategies that there are many strategies out there? The two I recommend is what they call follow the trend, and this is the easiest for a novice investor. Is a cliche in the market, the trend's your friend, and exactly that's what it's all about. Follow the trend. So buy when prices are rising and sell when they drop. So it's again that assumption that the rising prices or foreign prices will continue to do so. That's one way of doing it, and you'll see I use things like moving averages, trend lines to help you establish the trend. As long as it's staying above the moving average, the trend is up. Some of you might use what they call breakout trading strategy. I use this a lot. I look for chart patterns, you know, head and shoulders, especially a sideways moving market where the price is moving sideways. I have a top line, I have a resistance trend line, and a bottom support trend line. I wait for breakout, either up or down, and I take advantage of that. Okay, that is what I call a breakout strategy. I mentioned just now you want to buy low and sell a high. That's what they call following the trend. With breakout strategy, you might be buying high and selling higher. So just a change of mindset there. So this is the most important part, I believe, as a trader, is having a trading plan. There's just 10 things, and I suggest you go to Investopedia. You can click on this link here to give you more information on all these different criteria. But you can see there's 10 things you can look at. Your skill assessment. Before getting involved in trading, you can do some paper trading. You know, what if scenarios on Excel spreadsheet. I find the easiest to do this is to start small. and then from there build up. Because the biggest thing with paper trading, there's no emotions involved. And I mentioned just now, trading is a lot of emotion involved. You want to be more objective. So when I talk about skill assessment, do for a bit and see how your system's working for yourself. What's also important, we talk about mental preparation. To me, it's 80% mind games. So it's, you can talk about the 3 M's. Methodology is one of them, trading methodology. We talk about following the trend or breakout, that's the methodology. But mindset is very important. Being able to control your emotions, that greed and fear, and remaining objective, that's very crucial. And then your risk, that's the 3rd M I was talking about now, money management or risk management. Establish your risk level. How much are you going to lose? How much are you going to trade risk per trade? If I've got 100,000 Rand, I'm risking 2% of my capital per trade, which is about 2,000 Rand per trade. That's the most I'm prepared to lose per trade. So be aware of that kind of thing. That's what we call position sizing. So setting your goals very importantly. Before you enter a trade, set realistic profit targets, or what they call risk-reward ratios. What is the maximum risk or reward you're willing to accept? Most traders will not go for anything less than 1 to 3. I'm willing to risk 1 Rand to make 3 Rand per trade. So that is one of your goals that you want to look at. But also, I believe that my overall goal with trading is to be a consistently profitable trade. If I've got a string of trades, I'm doing 10 trades, and 7 of them are winning trades and 3 of them are losing trades, you are doing very, very well. If it's 50-50, that's fine, as long as your losses are very, very small. Okay, and understanding why you're making those losses, that's what's important. So when it comes to doing your homework, I find this the best thing to do before the market opens in the morning. Have you looked at what's happening overnight and what's happening in the States and things like that? And that's also part of the homework at night. How did the market close? What happened? And things like that. So that trade preparation, it's all part of that. Whatever trading system or program you're using, understand where the support and resistance levels are. Where are the turning points on your charts? Have it visual. So technical analysis is visual, tells you where the market's going to turn. So set exit rules. Now, most traders make the mistake of concentrating most of the efforts on looking for buy signals, but pay very little attention to when and where to exit. So the guys, the professional traders, they lose more trades than they win, but by managing their money and limiting the losses, they still make profits. But you need to understand, where am I going to get out? So that's what I'm referring to a take profit or a stop loss. Okay. So, and that obviously flows into the entry rules. You can have all your rules in place, but if you're not sticking to the rules, it's not going to help you much. So, the entry rules follows obviously the exit rules. So it's more important. Exit rules are more important than the entries. Okay. So your system should not, it should be complicated enough to be effective, but simple enough to facilitate snap decisions. And that's what a trading plan is all about. You can stick to that plan and follow it religiously. You'll be making money. That's the idea. But also very important is to keep records. I find this is one of the things that help me a lot. Many experienced and successful traders are excellent at keeping records. I have what they call a trader's journal. If you make a winning trade, I know why. That's important. It goes back to what I said just now. I understand exactly why and how I made those profits. But also, more importantly, when I make a losing trade, I want to know exactly the same why. So I don't repeat my mistakes. It's good to make mistakes. I believe in making mistakes. Fail forward fast. That's one of my slogans in life. But the idea here is to make mistakes and learn from them. Okay, and then analyze your performance. As I mentioned just now, you got 10 trades. If there's 50-50, it's fine. 5 winning, 5 losing. As long as they're small losing trades, the 5 trades will make it up for it. Okay. So guys, I'm running out of time here, but very quickly, I just want to highlight for you that the default, the Viewpoint Plus is a tool that you can use. So when you first log into the PHG website, and you go click on the Viewpoint Plus tab, this is the default setting. You'll see there's 3 windows. The idea here is to, I find, obviously you won't have a portfolio straight away, is to just to reorganize the screen. So to close the portfolio, there's a little button that you can close the portfolio, so you have two windows, two workspaces, and then change the order pad to a chart. And the idea there is that I want to compare my watch list to my charts, and the fastest way to scroll through it. So the idea also with the watch list is to click on that little button there. I can customize the watch list and take out the columns that are not really applicable. Okay, but I find also very importantly is to move a PE ratio column to right near the front. Okay, and you'll find it's a big time saver. So you can see also, here's my two windows. I've just minimized the watch list behind the scenes here, but now I'm going to link them, and these little buttons, as long as they're the same color, whatever shoe I'm choosing my watch list will automatically change the graph. And yes, I've set this up now to show me moving averages and MACD. You can do exactly the same thing. But also want to highlight for you, as I say, you bring a PE right in front here, okay? Watch list, by the way, you know, you can create, there's default watch list, the top 40, which is the top 40 large cap stocks. You can look at the mid caps and look at the small caps. But you also can create your own personal watch list. You know, you might have a watch list for your portfolio ultimately, but also you might have stocks on value, you might have stocks on growth, you might have stocks on for dividends. But the whole idea is to make the watch list smaller and more manageable. I find it's easier to go through the watch list here and then rank it by PE. So you can see this share here, MSG, multi-choice. You can see a PE ratio of 44. This is not a value stock. This is a growth stock, and obviously expensive if I'm a value investor. But whatever share I'm clicking here will change here, so I can go through this list very quickly. Big time saver. Okay. So also what's important is to as I say, to narrow down the list, but also when you're looking at the graphs, I can see just quickly, I can say to myself, is the share topish? Where's it? Is it trading far above its moving averages? You can see my moving averages periods here. I've got a very short one, 21, 40 day, 100 day, and a 200 day. That green one here is my 200 day. As long as the share is trading above my moving averages, the trend is up. Okay, those of you who want to follow the trend, the best time to have bought the share is MACD right at the bottom here. I want to get in over here, and I want to sell as close to the top as possible as a trader. Okay, but just you know, various ways, various tools I can use. If you click on this little button over here, by the way, brings out your drawing tools. I can bring in trend lines when it breaks up above this trend line, as I said just now. Buy high and sell high, yeah. So those are some of the ideas that you want to use. So guys, I'm running out of time. Just quickly summarize this. My hope is in this webinar presentation, my objective was to clarify the two broad approaches to making money on the market, obviously investing and trading. Hopefully you've asked that question for yourself. Am I an investor or a trader? Am I buy and hold or a buy and sell? Or am I both? If you're an investor, or you're a value investor or growth investor, or both, you can have both in one portfolio. And as a trader, different styles. Okay, so very briefly going through that as such. Just as a quick heads up, you can go click on these links. These are past webinars I've done. You can go look at the PDF of these presentations just to give you some more insight. Okay, so in conclusion, here's some links to some what you call key information documents. Those of you considering maybe opening an equity account or or offshore single stocks. The reason I'm saying this is that it's important to understand how the product works. What's the pros and cons of each product? You know, what can you invest in? What can you trade, etc. People get involved in this stuff and only find out afterwards they can't do this in a CFD portfolio or single stock futures portfolio. Okay, so the main thing with all the derivatives, just be aware of the gearing and the leverage. So it's risk. Okay, so guys, I've gone through this very fast. So say you might have information overload. Let me see what kind of questions you guys have. Let me see if I can open this quickly. Oof. Okay, Vessel, how do you get added to the WhatsApp group? Vessel, I'll have your hopefully your phone number and your account number with us, and I'll add you onto the group. Okay. Hannes says the slides are not moving. I don't know, Hannes. Question here from Yadela says, I suppose the only thing is how to use the trend lines and help me draw them. Okay, that'll be it for another webinar. The same as the moving averages. Okay. Hannes, okay. You had me worried there for a second. Okay, guys. Okay, looks like that's all the questions. Awesome. If you find that was useful and you want me to concentrate on more information going into future webinars, drop me an email. Just drop it here quickly. Here's our box address, the wealth at PSG. If you want me to concentrate more on trading more specifically, let me know what you guys want. If you want me to concentrate more on trading plans or trading specific strategies or investment strategies, be it value investing or growth investing, please let us know. You can also contact us on our OneStream line there, 0860 000 368. But from my side, guys, thank you very much for being on this webinar. I hope it was beneficial. You've learned something. Until next month, bye for now.